Good afternoon, everyone. This is Nate G. It is noon or a little after noon here on July 14th, and we are going to do a presentation on options in the lunch and learn section. Options are very in depth, and there is a lot to go over. So this presentation is really going to be kind of the basics of options. It's not going to get into any advanced option strategies, which that'll be, a 102 presentation and a 103. There's just a lot that you can dive into options. But just understanding options and how they work is pretty important to play them. I know I primarily play options. And I know a lot of people in here play options because it's a good way to get leverage on the underlying stock, and it can provide some outsized gains, but it's also in turn has more risk, so it can provide outside losses as well. So you have to be careful and understand what you're doing and all the factors that go into options and options pricing. So what are options? Options are contracts that give the purchaser the right, but not the obligation, to buy or sell a security, such as a stock or exchange traded fund, at a fixed price within a specific period of time. So that's kind of a lot to digest. But you don't actually own the underlying stock. It's just a contract that gives you the right to buy or sell the security within quite a few constraints. So a stock option contract, one contract, typically represents 100 shares of the underlying stock or ETF. So for an example, 2 option contracts on A and D represents 200 shares. One contract would represent 100 shares. 5 contracts would represent 500 shares. So that's the general rule, and that's why when using leverage, you're actually in control of 100 shares per contract that you have purchased or sold or whatever you're doing with your options. Oh no, sorry about that. I had an extra slide in there. Let me go back. Okay. The most basic options strategy is buying calls or puts to capture either a bullish or bearish move in the underlying stock. And this is called buy to open. This is a, kind of a options level 1 strategy. You don't need margin to do this. You can have this added to your trading account fairly easily, and you're relatively protected because you can only lose the amount that you put into the trade. And that is primarily what we'll kind of talk about today. So a call option, when you buy a call, it gives you the right but not the obligation to buy a specific stock at a specific price per share within a specific time frame. So buying a call is generally a bet that the stock is going to go up. It's a bullish bet. Conversely, when you buy to open a put, it gives you the right but not the obligation to sell a specific stock at a specific price per share within a specific time frame. Buying a put is a bet that the stock will go down. It's a bearish bet. And the reason people can trade these, or the reason people buy and sell options, is because they provide leverage. And traders that use options as leverage, since, as I said earlier, they can control a larger amount of shares, for less money. However, options also present more risk if you're not familiar with how to use them. Advanced traders, we're talking about buy to open, but advanced traders also use options in different combinations to protect their investment in a hedge. You can sell premium for income. You can sell puts to get a stock at a lower price. There's a lot of advanced option strategies that this presentation doesn't go into, but there's credit spreads, debit spreads. You can sell to open, you can sell naked. There's butterflies, there's iron condors, and all of that will be covered in an advanced option strategy presentation at a later date. Right now, we're going to focus on the buy to open, the simple option strategy. So this is a typical option chain readout, and to most, if you've never read one, it can be a little bit confusing, but we're going to break this down so we understand exactly what this is. So this is AMD December 17th, 2022, $70 calls at 310. So AMD represents your stock, the underlying stock. So that'd be AMD, it could be Apple, it could be SPY, it could be whatever. But that first designation is going to represent your stock. The next designation is going to represent the date the option expires. So in this case, this option expires December 17th, 2022. No, that's just an arbitrary date I put in here. I don't even know if December 17th is a Friday or not. So options always expire on a Friday. Not always. Sorry, I'll take that back. There are some daily options expirations on things like SPY. There's a Wednesday expiration, so I take that back. But most stock expirations happen on Fridays. Then you have your strike price. $70 is the strike price. The type of option is a call, so that would either be a call or a put. And then the premium for one share of this AMD option is going to be $3.10. So if I am buying one contract of AMD December 17th, 2022, $70 calls, it's going to cost me $310. So that is the premium in which I am paying. It's the contract. It is the down payment, essentially. So what I wanted to do before we got to this part is show you what an option chain, an option strikes looks like. And so here is Thinkorswim. We have AMD pulled up. We have our different expiration dates. We have July 15th, which is tomorrow. We have July 22nd, which is next week, and so on. And you can see this week we are in an options expiration. So there's monthly expiration, and then there's weekly expirations. We are in a monthly expiration. So this is the July expiration date. This is also called OPEX week because the options expire this week. The monthly options expire this week, but a lot of these underlying assets have weekly options as well. So these are our option expiration dates, and then we have our strike prices here. So the at the money price for AMD expiring tomorrow at $77 is $137 essentially. And so we have our bid and our ask. The calls are on the left side. The puts are on the right side. And so it's a lot to digest when you look at a screen like this. to try and understand what you're looking at. So if we were looking at the 80, let's say we're going to do the 76, the $76 AMD calls expiring July 22nd of this year. That's in 1 week. $76 are going to be $330, about $340. You can see the bid and the ask spread here. So that would cost me $340 per option that I wanted to purchase. So any questions there? So when we get into talking about these options, and we're buying to open on the put side, let's say we wanted to buy a put right now. On the put side, the $78 puts for AMD right now would be about $130.31 per. Right. And so this would be buying on this side would be a bet that the option is going to go down. Buying on the left side would be a bet that the option is going to go up. So then we talk about in the money and out of the money and at the money. So when we say that an option is in the money, for a call option, this means that the stock price is above the strike price. So if a call has a strike price of 50 and the stock is trading at 55, that option is in the money. And on an option chain here, you'll see that the in the money is in a darker section, and the out of the money, which we'll talk about in a second, is in a blue section, and then the out of the money is in a black. So conversely, our out of the money for call options, this means stock price is below that price, below the strike price. And for put options, this means that the stock price is above the strike price. So the price of out of the money options consists entirely of time value, which is theta, which we'll talk about in a minute. And so in the black areas on the call side, this means we're below the strike price. And you can see that the pricing it decreases in the out of the money on the call side. And it also decreases in the out of the money on the put side. And you can see they're inverse. Okay, so in the money is blue and out of the money is black. So on a bet that the stock price is going to go up, right? If we're buying a call and the stock price, we're betting that the stock price is going to go up, that would be the continued in the money. The in the money options would continue to flow up. And what I did not include in this presentation, I need to add a slide here for future use. The phrases we typically use are in the money, out of the money, and at the money. So right now, AMD is trading at $77.65. So the $77 strike is at the money. So when we say we're buying at the money, that means we're buying the 77 or the 78, depending on calls and or puts. So those are the three things that you would hear somebody where an option is in the money, it's out of the money, or it's at the money. And I did not put a slide in for that one. And the expiration date is key because generally, if you're playing a long call or put, you want to close the trade prior to the expiration date, or you risk getting your options exercised. So the expiration date on an option, what you're paying for is the right to buy or sell that the underlying stock within a certain amount of time frame at a certain price. And so the time frame factor is that the expiration date, like let's say we had bought the AMD July 22nd calls, as July 22nd comes up, that means that that option will expire on the 22nd. And if the owners of those options are still holding them through that expiration, they risk getting exercised. And options expiration, if it gets exercised, that occurs when the owner of an option invokes the right embedded in the option contract. So in layman terms, it means the option owner buys or sells the underlying stock at the strike price and requires the option seller to take the other side of the trade. So if you let an option expire, that most option traders will close their trade prior to options expiration. So let's say you have a put, you've bought a put, and the option is out of the money. You are going to risk being put those shares if you own that stock, meaning you'll get put 100 shares per contract that you still own past expiration. So how is the options pricing created? Sorry, I keep going up and down on this. How is options pricing created? Option pricing is set and can fluctuate depending on some key criteria, which is why options can be both so valuable and also so risky. So option pricing is based on implied volatility and then the GREEKS. So it's important to understand the GREEKS. They're delta, theta, gamma, and vega. And when you're buying calls or puts, delta and theta are kind of the more important ones to really pay attention to. So implied volatility is a dynamic figure that changes based on the activity in the options marketplace. So usually when an implied volatility increases, the price of the options will increase as well. So if you are the owner of AMD at $3, so at $3 per contract, and an event happens in the marketplace, or it's right at the open where there's a lot of volatility, you'll see the price of that option jump. And that's kind of this implied volatility in these options, and that's what's helping control that price. And so when there's a lot of volatility in the market, that price is going to go up. And if there's not a lot of volatility, that price is going to stay relatively low. And you can see that fluctuation. So if you buy during a quiet time, let's say you buy a call during a quiet time, and some news comes and the option goes in the direction you want, you can really get a quick jump in price. Conversely, if you're buying during a high volatility event, and let's say you buy a call during a high volatility event, and that call, it continues to go up or go sideways slowly, but the volatility comes out of the market, your option will actually lose money or start to lose money as the volatility comes out of the market. Whereas if you just owned 100 shares of that stock, it would stay true to the price. Delta is the amount an option price is expected to move based on a $1 change in the underlying stock. And this is kind of an important one, and it is really important when we talk about the strike price in an option. So and this is one I'll probably talk about the most. So if I am looking at the AMD $77 calls, they have a delta of 0.54. Okay, so if I'm buying this option, these are not, when you buy options, they're not just a one-for-one move in the stock. So if I'm buying the $77 and they go up to 78 and the price goes to 78, I am not getting a full $1 move per 100 shares. Right. So if each one of these options was worth is 100 shares, and it was going to move exactly with the underlying stock, and I bought AMD at right now at 77.29, and I bought one contract, so I have 100. I'm controlling 100 shares at 77.30. And it goes up to 78.30, I don't get, if I bought at the money, these Delta 54 options you can see here in this column, I'm not going to get a full dollar's worth of move. Okay. This is telling me that for every $1 move in the stock, this is the delta, I'm going to get roughly 50 cents of that move, right, in price. So they're not a one-for-one unless you're buying deep in the money, as you can see these $72 ones, because the $72 strike price in a call, we are already in the money because we are above $72. And so this one will move 80 cents for every dollar that the underlying stock moves. So conversely, if you're way down here out of the money and you want to buy a cheap option, let's say you want to buy the $81, that is only going to move 29 cents for every dollar move in the underlying stock. So that's a factor. And of course, as you move up, that strike price does adjust. But right now, that's the amount of movement I'm going to get in the stock. And that's what delta is. And so that's pretty important when you're buying options. You're not going to see as big of a move in out of the money options. Same thing on the put side, right? The $83 puts, because we are below that, we are in the money. The $83 puts, do I not have delta on here? Oh yeah, delta is way over here. Are at a delta of 81. So they'll move 81 cents for every dollar move in the stock in the direction that I would like it to go down in that case, right? So the other Greek that's really important, and we use quite a bit, and is really a factor in options trading, is theta. Theta is the amount of the price of the price the calls and puts will decrease. It's called theta decay for a one-day change in the time to expiration. So the theta is a decay in the option price as you get closer to expiration. So you can see it here in the option chain. This, let's say we're looking at the $77 calls at $2.70 per. We're going to go at the money, right? If we would like to buy the $77 calls that expire next Friday, we're going to pay roughly $2.70 for that option, because we have 8 or 9 days till expiration, right? So we're paying more for more time. So you see, as you come out here, the $77 that expire in 15 days are, $3.80. The $77 that expire August 5th, or 5:15. So you're paying for more time, but what you can see theta is the time decay. So as you get closer to the option's expiration, that same value option will be worth less. And theta decays on a curve. So the further out you go, and I don't have a graphic for this, I wish I did. The further out you go, the less theta decay you're going to get over time. And it essentially ramps in the last week. That theta decay ramps the price down pretty quickly. So in the week of expiration, that theta decay will start to decrease the price of your option, even if the price is not changing. And that really ramps up in like the last 2 to 3 days. So if your option is going nowhere, then that price will decrease really rapidly, which is also why selling options and collecting premium, these are all based on premium, right? So there's an implied volatility premium, there's a theta premium because you're buying options that are out many weeks. So that's why this decay really can be advantageous to the seller of the option. But right now we're talking buying options. Vega is another one of the Greeks. It's the amount the call and put prices will change in theory for corresponding 1 point change in implied volatility. So Vega relates to how responsive they are to changes in implied volatility. And gamma is the rate that delta will change based on a $1 change in the stock price. So if delta is the speed at which option prices change, gamma is the acceleration of that. So at the moment, that is the options basics. If there are any questions that you'd like to go over, obviously options are really, really in depth, and there's still a tremendous amount to go over. But this presentation is Options 101, and it's about the basics. So if anybody has any questions, let me know. I'd be happy to go through some real world examples if you'd like. But that's the Options 101. No questions? Kyle, do you have any questions on any of that? I know it's kind of a lot to take in. If you are, what are you still here? What platform are you on? Are you on Thinkorswim or TradeStation? Yeah, sure. So let's say, let me go to a chart here, since we've been using AMD and it's Donnie's favorite. Let's say we were going to set up a long bet on AMD. This is the AMD 1 minute chart. Now let's do something not quite so tight. Okay. So I have a key value, and what you'll start to learn is as you go is we also use VP, which is these are the VP levels on the right hand side, and there's a couple of presentations in the education section on using VP. But let's say in theory this is AMD on a 30-minute chart. I'm going to kind of zoom in here, and I've drawn a level here in red. Okay, and that level is based on volume profile. But let's say I'm going to make a bet. I think that AMD is going to go up. Okay, I think AMD is going to move from this red line to test the high of that volume profile area, that value area high. Now I know you might not know what that is yet, or you might. I don't want to talk like I don't want to make assumptions, but my bet is that AMD is going to go from 77.14 to 79. Let's just say it's going to go to 80. Okay, let's make that nice and easy. And I don't. I want to use the leverage provided to me in options. And I think since we're looking at a 30-minute chart, I need to give myself some time, because the bet that I'm making is that, or I think that AMD is going to move from this pullback down to this level, and we're going to go and hit 80 and maybe clear 80. So if I'm looking to buy an option, this is a 30-minute chart. I think, I would probably want to give myself some extra time. So I am going to go to my options chain. Well, let's see if I can figure out how to get over to the options chain. There we go. So I'm going to go to my option chain, and I'm going to say, okay, so I think AMD is going to $80. I don't necessarily have to buy the $80 strike because I'm looking for the move up. I can buy anything at the money or slightly in the money because I don't really want to risk time decay. However, we're looking at a 30-minute chart here. So this, I would want to give myself time for this option to make the move I would like for it to move, right? So I'm going to go further out. Let's say I buy the August 19th. So let me close some of these. Okay. Say I buy the August 19th, and I could buy the slightly out of the money. So I'll make that a little bit bigger. So the $80 calls, in this case, we have $5 differences between our strikes here. The $80 calls are $4.80, or 82, 83. Here's our spread, right? 480 to 485. And it has a delta of 47. If I want a little bit more delta, I can buy the 75s at $7.32 ish, somewhere in the middle of the bid ask. So I would say, okay, I'm going to give myself out to the middle of August. I'm going to buy the $80. Actually, I'm going to buy in the money or at the money. I'm going to buy the 75s at $7.30. And I'm going to buy one contract because I'm learning to buy options. Obviously, we want to know our risk, so we need to know what we're willing to risk on that trade. But that trade, if we're going to buy one AMD contract at $75, $75 strike is going to cost us roughly $7.40. So then I would buy to open, which for me, what platform are you on, Kyle? Anyway, you're going to buy to open. I'm on Thinkorswim, right? So this would be a window here, a active trader window. So for me, I would copy that, and then I would go to the active trader window here and go, and then I would place my $1, my 740 price, I would buy one contract on AMD by doing that. No, what I was asking what your trading platform is. Do you use E-Trade? Do you use Thinkorswim? Do you use Schwab, TradingView? Oh, okay. So I would buy to open the August 19th, $75 AMD calls at 740. And then I would own that contract. It has a delta of 61. Okay, so for every dollar move, I'm going to capture 61 or 60 to 61 cents of that move. And I don't have theta listed on here, but going out 36 days, I'm not worried about theta until I get about 8 days in, 7 or 8 days in. Does that help? Conversely, if I am playing, let's say I'm playing AMD on a 5-minute chart, shorter time frame, right? And let's say, I could only spend $800 on a trade. On the 65-minute, if I'm going to spend $800, I could buy one contract, right? But if, let's say, I wanted to invest $800 and I was playing a shorter time frame, so let me go to a 5-minute. I'm playing a shorter time frame. I think in the next 30 minutes, AMD is going to bounce off this level that I have and come in and just test the day's high to 79. Right, that if that's my strategy right now, which I don't recommend, by the way, I'm kind of picking. I'm just picking an idea out of the air, right? I don't think that's actually going to happen. I can come into my option chain and go, okay, I think that's going to happen before the end of the day. Let's say I really wanted to place a risky bet. I was pretty sure I could buy the at the money $77 strikes for tomorrow's expiration, and I could buy 6 or 7 contracts, and now I'm controlling 600 shares of AMD. However, I need that move to happen quickly, or else I'm risking a very quick theta decay, especially if I hold these overnight. That theta decay will bring the price of these down. So the closer you are to expiration, you need that movement to happen. And so a lot of times the theory is always buy yourself extra time. You can always close the trade, right? So even if I thought this was going to move up today, if I wanted to stay a little safer, if it might take till tomorrow to move up, I could buy the $77 calls on July 22nd and buy myself time, right? So basically, you're just buying the time, but you'll get the same movement. And so as you're playing with options, you can buy more for your account size, right? Buying closer to expiration. But when you buy closer to expiration, there's a lot of risk there that if it doesn't make the move you want it to make right away, you're going to lose. You're going to lose to theta decay. Is there any other questions? I personally feel like that was more rambling than it was helpful, but there's just kind of a lot to cover, and even as we're going through the presentation, I know there's things that are missing that need to be added, and need to be explained better. So, giving these and building these presentations also helps. Also helps, to kind of flesh out what needs to be added and what needs to be taken out of these presentations. So, yeah, Christine, that's a great point. The monthly option expirations have a lot more volume and a lot more activity. So that's, and there are, let's see, there are names, stocks that only have the monthly expirations. It's a lot more, these more liquid stocks, like, your AMDs, your NVIDIAs, your Apples, they're the ones that have the weekly expirations. So they give you a little bit more flexibility. But most of the stocks that trade options, not all stocks will trade options, will have those weekly expirations. So that's why an options expiration week like this, those are important to note, because many times the market makers will shuffle will shuffle things around, move you up, move you down, and really they're just trying to suck out the implied volatility and hurt the most people possible. So at any rate, that's the Options 101. If you have any questions, I'll be in chat, and thanks so much.